I guess old age is pretty good because you kind of forget about these things and remember that you got through it, you know. So just a quick update on it. In the 70s, when I came to New York, was 1970, the garbage was piled 20 feet high in the street, the sanitation people were on strike, the subways didn't run, and there was no money. And if it wasn't for some pretty astute business guys here, we'd be bankrupt. So now we're seeing cities bankrupt. A couple may go bankrupt. That's in California, but that's the way it looked. So all we're doing is repeating what happened before. In early 80s, we had the Carter administration, 21% interest rates. Savings and loans could only borrow short and lend long. Now, how do you live with a 21% interest rate when you got a 4% CD that you get, jumbo that you just sold out 5 years? And that's the maximum you can get. So literally the law created that disaster. In 1987, we had a day that the market was down 500 points from 2000, so that's probably the worst day in the history of the world. It came back in 2 weeks or 3 weeks. Everything kind of righted itself again. So, but then, of course, everybody here lived through 2001, and that wasn't much. As a matter of fact, it was very interesting that I was teaching at Thunderbird at the time, and one of the venture capitalists gave a lecture and says, well, don't worry about money. They're going to hand it to you when you need it. And it was a venture capital meeting. Well, of course, that's the way it was then. And I couldn't believe it. I mean, I sat there and I got up and kind of gave a speech and said, don't believe that. But that's the way it was. And, of course, everybody paid the price. What will happen is this will be over at some point, and we'll forget about it until we get to the next crisis. The only thing I'd like to mention is, though, that as we get smarter and smarter, and information flows more freely among people, the crises come closer together. And the recovery time is also faster because there's always somebody that's figured a way to do it, a country that's figured a way how to do it. You've got India and China coming on now. They're going to get hit. They both slowed down, but they're still doing pretty well. So we'll recover this time. The United States won't be at quite what it was, but New York will always be the financial capital, at least while I'm around. And so that's my story.
Just to give perspective in our portfolio, and probably repeat some of what Habib has shared, but we don't take perspective of short term. We don't market time, and actually the best investments are made during these times that the market is consolidating, so to speak. But I also think it shifts to think about your business model and how you manage through times like this. So we definitely back cash flow disciplined entrepreneurs. 2/3 of our portfolio over the last 3 years has completely shifted to recurring revenue models. So in times like this, in a subscription-based recurring revenue stream, you can bring back expenses and understand how to weather the storm and get there and still increase investment in sales and marketing and build. And I think the market is rewarding that from the multiples you see in SaaS-based companies that actually go out there. So I would encourage you to think about that if you're on the software side. I also think we're trying to extend runway to be cash flow disciplined. So there is a great market right now, frankly, for venture debt and how we incorporate that into our portfolio investments. I would tell you, we're closing dozens of those deals to extend our equity. It's non-dilutive to the entrepreneur as well as us. They're sharing the risk with us in a longer-term perspective. So that investment vehicle has served its purpose pretty well in these times right now. From an exit environment, there's definitely a flight to quality. We're seeing more of our companies that help the bottom line, so to speak, from a cost efficiency standpoint, be acquired versus, synergistic revenue, generation from a business unit level at a larger organization. Those deals are being put on hold, and valuations are coming down. Certainly with leverage out of the door, strategics, can play a bigger part, and going after deals at reasonable prices. It's just always the dance between the bid ask, and if we think it's reasonable, but we'd rather hold for longer term for a higher outcome because we know the market will come back eventually.
Well, I detect a slight difference of opinion up here on the panel between some of the institutional and the angel investors, which is very interesting. And I think that sort of points to a risk aversion that's building into the market, particularly on the institutional side. As probably the biggest institution here on this panel, I've noted that in our institution. Now, we don't have the same pressures as a lot of the venture firms to deploy our capital as quickly because it's out of our own working capital. And so we don't need to, fund the companies as quickly and, support our limited partners' investments in that same respect. But the head of our Intel Capital was the ex-treasurer of Intel Corp. And about 8 to 9 months ago, he said cash is king and be very, very selective. So for a very big company that has over 150 investment professionals worldwide, I've noticed immense selectivity in terms of our investment philosophy, and I would think that you've heard some of the other venture firms up here repeating that. I think, therefore, it's very important. By the way, I was really impressed by the elevator pitches. They were excellent. I don't know what coaching went on, but they were all very much to the point. Very quick, very important that you focus and that time is of the essence, because I think there is going to be more competition out there. Capital is going to be more scarce. Many venture firms, I think, aren't going to be able to raise, some of their next funds, in this environment. Some of the returns that have come out, aren't as good. So, given that that's the case, time is a premium. If you can get to the point, say what your product is, what the differentiation, the innovation, establish a rapport very quickly with the investor, I think that's very important. The other thing that I've noticed just in the last 3 months is, especially since I'm in sort of the consumer internet digital media space, where the valuations are very high, as Habib said, and not aligned with the public markets at a premium, which doesn't make sense and is not sustainable. It's very important in any of those businesses to have a business model, have a plan to monetization, and to become a standalone business. And like Ryan mentioned, we're spending a lot of time on our portfolio companies, making sure they're well funded, either doing follow-on rounds with our co-investors, working with the venture debt institutions, but also making sure that they're capital efficient, as some of my esteemed colleagues have mentioned here today. And I think that's going to be increasingly important. The other thing that hasn't been mentioned is I think you're going to see more consolidation in all of these industries. We're already seeing in the financial sector, it's going to happen soon in the insurance sector and others. And I think it's important that some of you that don't have differentiable products that work with other companies, you're probably going to see more roll-ups. We're seeing it among our own portfolio. Is there an opportunity for them to partner with someone, bring them in? There'll be great opportunities in this downturn. And that being said, now that I've had a little bit of gloom, we did invest in the last downturn. We're continuing to invest. We invest, stage agnostically, early stage through to later stage. And, you guys are the future that will lift us out of this, so keep up the good work.